afternoon. Good morning. So today now we are moving to a new standard, IS 8. Accounting policies, changes in accounting estimates, and last week what we looked at was revenue. How many of you watched the video? You are not watching it? Yeah, I think you should watch it. You would really help you, yeah? Okay, so now, for that revenue, the major thing there on is the objective of that standard, which is that the revenue recognized in P&L must depict the consideration you are entitled to, okay, for transfer of goods or services. Which means that you can only recognize revenue when you have transferred goods or services. That is the objective of that standard. Then we went on to the 5-step model. You need to be able to list that 5-step model. I can ask you, how do you recognize and measure revenue? Is that 5-step model? You must know step 1, which is to identify the contract with customers. You must know step 2, which is to identify the separate performance obligation. You must know step 3, which is to determine the transaction price. You must know step 4, which is to allocate the transaction price to the separate performance obligation. And you must know step 6, step 5, which is to what? Right. So for the step 1, nobody will ask you to define contracts. Okay? But we know it's an agreement that has enforceable rights and obligations. What they will ask you in the exam is the 5 criteria for a contract to meet IFRS 15 requirements. The 5 criteria, right? What's the first one? The parties must have approved the contract and must be committed to it. What's number 2? Each party's right to the goods or services must be identified. Number 3, payment terms must be identified. Number 4, what's the meaning of commercial substance? There must be cash flow. Yes, money must change hands. There must be commerce and risk. Yeah, money and risk. Good. Number 5. Exactly. And number 6. You must know all that 6 by heart. Yes. They have asked it in the past. They can ask you again. So you must know it. And the best way to do that is definitely, okay, but you must not lose the main point in each of them, right? You must not lose the main point. So you should be able to sit down, write those things yourself down. They can ask. And if you have practiced written it down over and over and they don't ask, yeah. So then we said that if a contract does not meet these criteria, we said you cannot recognize revenue, but rather you recognize a contract liability. We went ahead to talk about contract combination and contract modification. We said a combination that you should combine 2 or more contracts that you entered into at the same time with the same customer. Combine them as one. If you negotiate the contract as a package with a single commercial objective, we said if the price of one depends on the price or performance of the other, and if the contract of the goods or services in the contract can be delivered as a single package, combine them together. And for modification, we said modification is a change in the price or scope of a contract. That a change in scope or price will be treated as a separate contract if the scope increases. Okay, if the scope of the contract increases because of additional goods or services, that is what? Distinct. That's the key word there. And also, if the price increases by an amount that reflects the standalone selling price of the additional goods or services. Okay, so those two must be present before you would treat a modification as a what? Separate contract. Okay, those were what we discussed in step 1. In step 2, we said identify separate performance obligation. Because ordinarily, when you sell, you are selling goods or services. Those two goods or services are the performance obligation. You need to identify each of them separately, because you are going to account for each goods or services separately. And when we say separately, it means the goods or services must be distinct. For it to be distinct, it means that you have sold it separately because it has a distinct function and a distinct profit margin. Distinct function means that the customer can enjoy benefit from that goods on his own. Distinct profit margin means that that goods or services must be separately identifiable, which means it is not integrated with another goods or services. It does not modify another goods or services. It is not highly dependent or highly interrelated with another goods or services. Went to step 3, which is determining the transaction price. And we said the transaction price is the price or the consideration you are entitled to in exchange for the transfer of goods or services. But this consideration must exclude any amount paid to third parties. I'm not sure I mentioned that. But yeah, you don't include VAT. You don't include VAT in your revenue. Yeah. You don't include VAT. So, or any amount you collect on behalf of third parties, you don't include it as revenue. You see, there are some companies, like let's say Uber, for example, now they have an app that where you can go there, order a ride, then you pay. If you pay via Uber platform, the money goes directly to Uber. Uber cannot recognize the entire money as revenue. They cannot. They only recognize their own fees or commission. Okay, so because their own transaction price is that fees or commission. And we say that transaction price can be affected by variable considerations like discount. It could be affected by time value of money, whereby you have added interest. It could be affected by non-cash consideration. And also there are instances where you say you want to give customers bag of rice, RAM, and all of that, when you have promised the customers some things back. Also, that might also be deducted from your revenue as well. So we went on to step 4 that talks about allocating the transaction price to the separate performance obligation. And this will usually happen when you have a single transaction price for multiple performance obligation. We say you need to allocate that single transaction price to this performance obligation based on their standalone selling prices. And finally, we talked about recognizing revenue, which is step 5. When performance obligation is what? And you satisfy performance obligation either at a point in time or over time. When it is over time, the way you recognize revenue is in 2 ways. Number 1 is if you can measure the outcome of the obligation, of the performance obligation. If you can measure the outcome, then you are going to recognize revenue based on the performance completed till date. But if you cannot measure the outcome of that performance, you are going to recognize revenue based on the cost incurred till date. And talking about cost incurred till date, I told you that is a contract cost. And contract cost is either the cost of obtaining a contract or cost of fulfilling a contract. Cost of obtaining a contract are those ones that probably when you spend it, you get the contract. You capitalize those ones. But there are some you spend, regardless of whether you obtain the contract or not, you expense those ones. But cost of fulfilling a contract are the costs you use to do the project. You will be capitalizing it. But as soon as you start transferring those goods or services, you start amortizing those assets to P&L. Just so that you can be matching your revenue with almost exactly the same costs in your P&L. Okay? But when performance obligation is satisfied at a point in time, you recognize revenue when you have transferred control to the customer. Okay? Then you recognize revenue at that point. Okay, so that was the 5 steps. And finally, I told you the difference between a contract asset and a trade receivables. I told you the trade receivables is a right to consideration that is unconditional, except for passage of time. It's just passage of time. But contract asset is a right to consideration that is what? Conditional. You still need to do 1 or 2 things. Probably you need to send invoice, you need to do some things, any future performance that you're supposed to do, then you would recognize that as a contract asset. Those were what we learned last week. And by now, the way I've revised it in under 10 minutes, that is exactly how you read for your exams too. You should be able to read the standard and sit down under 10 minutes and write it down. There's no way you can fail like that. It's not possible. At least you won't fail. In fact, you might even go and win prize. If you sit down, you read something, you read it. You are not in a hurry to move to another one. You read it, you now sit down, you now write it down. Like, this is what I've read. Like, okay. Let's go to the next one. IS 8. This one is very short, so we won't take so long on this. Short and straightforward. There are 3 things you want to deal with here. Accounting policies. We have changes in accounting estimates. And we have errors. So just listen and try to understand what they each means. So, let me start with the first one under IS 8, which is accounting policies. So what is accounting policy? Let's try to make sense of what an accounting policy is. So it says that an accounting policy, these are the concepts, okay, the rules, the principles, the conventions, what again? Practices, the basis, what again? Standards. I'll not write down. That are used and applied in the preparation okay, you can put that on too. In the preparation of financial statements and presenting too, yeah. Okay, now let's focus on the key thing here. Okay, you can put it however you want to put it, but don't lose sight of the main points there. So when we say accounting policies generally, they are all the rules we have been teaching you, they are all the principles we have been teaching you, all the conventions, concepts, anything that backs up preparation of accounting. Yes, that is an accounting policy. All these standards, myself and Mr. Ibrahim has been teaching you, they constitute our accounting policy. That is a policy. So we can summarily say that accounting policy is just one, as far as IFRS is concerned, the IFRS and I'm taking IFRS and IAS together, and the conceptual framework. This is accounting policy. Okay? Because they said these are plural. This is accounting policy. Your IFRS and your what? Conceptual framework. Okay, so why are we now talking about this? Because we're already learning about all these standards individually. So why am I saying all of them is accounting policy? Why? Okay, there's a reason for that, right? So IS 8 firstly deals with selection of an accounting policy. Because we know that you cannot apply all the standards. You will only apply the standard that relates to your company. Okay? So you need to select the standards that relate to your company. That's selection of an accounting policy. So when you select a standard, like for example now we did IS 16, right? We learned a lot in IS 16 from recognition, to measurement. In fact, that measurement, initial measurement, subsequent measurement, and we did a lot of calculations under those ones. You see, all those things we learned, that is accounting policy. And for example now, subsequent measurement, for example, subsequent measurement will say that you can either measure your item of PPE either at using cost model or evaluation model. You cannot use the two. Abi? Yes. So you need to tell us which one you have what? Which one you have applied. Okay, so selecting one of them is where accounting policy really comes in. That, okay, what is your own accounting what? Policy. Which one have you chosen? So in accounting policy, you need to tell us on all the items, like for example, your assets that you have bought, you need to tell us what was the recognition criteria you used. Even though you are rewriting what we have, you need to tell us what was your measurement basis, the initial measurement, and your subsequent measurement. You need to tell us that for all the items in your financials. That is accounting policy. So you now see that accounting policy for all companies will not be the same. Even though accounting policy is IFRS, but it's like IFRS tailored to a company. Abi? Yeah. That, okay, this is the way you have, this is what you have used in the IFRS. That is an accounting policy. So when you pick up a financial statement, one of the very first pages you will find after all the story, when you get to the part of financial statement itself, is accounting policy. That's the first. Because that's when you explain to us the standard you have applied. So in fact, if you want to revise most standards that I'm teaching you, just go and pick up accounting policy of any good companies, any of these quoted companies, right? You will see them. PPE, they write the recognition criteria, measurements, initial, investment property, like that, depending on what they have in their books anyways. All these things we have taught you see that they will write everything there. Everything. Because they will have applied that. That is an accounting policy. So accounting policy is majorly IFRS and the conceptual framework. So selection of accounting policy. So from what I've said so far, it is very clear that when you want to select policy, it's just purely from the IFRS. But the challenges now come when you are now dealing with a transaction that does not have an IFRS. So how do you select accounting policy? How do you treat, when I say how do you select accounting policy, it's synonymous to saying how do you treat that kind of item. Abi? Yes. So what do you think? If you want to, let's say Bitcoin now. Let's say your company purchased a Bitcoin. There is no standard that deals with cryptocurrencies right now. Okay? So, and your company bought it. So now, you have to, any item on your account, you must have an accounting policy for it. You must state it. So, how do you treat that? Where do you get the policy? Which standard are you going to apply for that? So IAZ says that you need to look for a standard. I mean, part of those IFRS that deals with a similar asset. That deals with a what? Similar asset. So for cryptocurrency now, we usually conclude that it could either be intangible assets or it could be inventory. Okay? Either intangible asset or what? Inventory. So those are similar standard, and those are what we're going to what? Apply. What if there is no similar assets? Well, what if we can't find a similar asset to deal with that? Where do you think we will rely on to develop or select our accounting policy? No, before you get to that, there should be something else. Conceptual framework. Yes. You know that if you remember, conceptual framework is the tool that provides the basis for the development of accounting standards. So if there is no standard that deals with an item, and you need to select an accounting policy, you rely on that conceptual framework. Just look at, okay, because conceptual framework has already, it was what defined assets, liabilities, equity, income. It told us about recognition criteria, recognition, measurement, presentation, and all of that. So by the time you look at that, the conceptual framework will tell you how you should treat it. So it will tell you whether that item is an asset, income, expense, liability, or equity. It will tell you. And it will tell you how you're going to do it. Okay? What if the conceptual framework can help? Mostly the conceptual framework would have helped. We expect it should have helped in almost all cases. So if it cannot help, ISA says that you can then look for other standard setups, like the FASB. Okay, but they must use similar conceptual framework with the ISB. Okay, they must use what? Similar conceptual framework. Then you now go and check, do they have a standard that deals with that item? Do they have a what? A standard that deals with that item. If they do, use that to select your accounting policy. Okay? Similar standard setting body that use similar conceptual framework. Use their standard. What if that can help?
What if that can help?
What I said you now apply.
Okay.
What I said you apply. So you are not going to check, okay, accounting literature from the academias, right? You look at the standard practice that other people that have faced this transaction, how they dealt with it. Of course, however they treat people, you must not be against the conceptual framework. Okay? See, this thing I've mentioned is very important. Yes. So I was talking about selection of what? Of accounting policies. When you are selecting accounting policy, what's the first point of call? IFRS. And it is in this order, IFRS. If the IFRS can it help? Conceptual framework. But don't forget that in case that particular item does not have an IFRS, you can use the IFRS of a similar asset or liabilities. So conceptual framework. If the conceptual framework does not help, so this is what the standard requires. This is more reliable. So they said that if this one cannot help, so they now suggested. Yes. Similar standard setters that use a similar what? You can use their standard. You can use the standard of a similar standard setter that use a similar conceptual what? Framework. What if that cannot help? Accounting journal, accounting literatures. Which one? This one does not work. Dead that transaction. Sorry? A pronouncement, accounting literatures, or pronouncements in academia. Okay? And they must not be against conceptual framework. See, look at it. I want to make a very important point. So, I'm done with selection of accounting policy. This is the point I want to make. So, the standard says that from here up to this point, it says that you are making use of your what? Judgment. You are making use of your what? Of your judgment. Okay? Just that we have now guided your judgment. We have guided that first, for this one now, you use a similar, maybe you have a similar asset. IFRS of a similar asset. Conceptual framework. Similar standard setters. You can use their standard accounting literatures like that. Okay? So that is how you select accounting policy. So what I'm sure that you know right now is that you now know that accounting policy is majorly IFRS and conceptual framework. Okay? Accounting policy is just saying that okay, this is how I've applied each of my items. This is how I've treated them. You need to explain it, all of it, in your. When you check companies for their revenue, you will see them explaining all the 5-step model. They will now tailor it to their own, everything like that. It's always there. So this is how you select it. When you want to select accounting policy, this is the process. Now, after selection, after you have decided on accounting policy, then the next one is consistency. Consistency of accounting policies. Consistency of accounting policies. So, of course, that's very clear. When you choose a policy, you do not change. Yes. You cannot change it for life. Which okay, what type of situation? What type of situation might warrant that? So, I mean, since you mentioned that, since you mentioned that, a change in definition method is not a change in accounting policy. Even though I've not brought you to changes in accounting policy, I'm still going to get there. But a change in definition method is not a change in accounting policy. It's a change in accounting estimate. What is it?
A change from cost model.
Because selection of those methods is a selection of an accounting policy. It's a selection. When you select, it's a selection. But when you change it, it is a change in accounting estimate. Yes. So I will explain that very soon. I'm just moving there gradually. So I am on selection of an accounting policy. No, I'm on consistency of accounting policy. So when you choose an accounting policy, you can change. And choosing accounting policy, like I've mentioned, is like you are choosing an accounting treatment relating to recognition, measurement, presentation. Okay? All of those standards, by the time you explain to us, okay, how did you recognize, how did you measure, that is selecting an accounting policy. When you select one, we do not expect you to what? To change. That is consistency. But he was saying that, do I mean for life? Does that mean we cannot change? Okay, we can change. Under two conditions. Under two conditions. Under two conditions. So changes in accounting policies. So number one, you can only change accounting policy if it is required by an IFRS. If it is required by what? An IFRS. Number two, it results in a reliable and relevant it results in a reliable and relevant financial statement. It results in a reliable and relevant financial statement. These are the only two instances where you can change your accounting policy. Other than this one, you cannot change. You must be consistent with it. So, required by an IFRS. For example, now, you see, IS 23 on borrowing costs now. Borrowing costs under the old IS 23. It requires that you can either treat borrowing costs as either an expense or an asset. You give that option. But the updated IS 23, and IS 23 says that all borrowing costs that meet that capitalization criteria should be capitalized. That means they have updated the standard. That means your policy will what? You have to change. It is required and there are a lot of instances like that. When they changed the principles for impairment of financial assets from incurred loss model to expected credit loss model, that's beyond our scope here. But you have to change your policy too for that. Another one is that if it results in a reliable and relevant financial statement. You see, for example now, let's say we had a building that we were using for our office for administrative purposes. When you have a building that you use for administrative purposes, how do you classify that building? PP. I mean, PP. So let's say you are using cost model. That's your policy. Cost model. But later, circumstances change. Okay? You now decided that you want to move away from that building to another location. But right now you are not using that building, you now rented it out. So you rented it out. So when you do that, that building automatically becomes an investment property. Whatever purposes, you rent it to another party. Okay, you rent it out. Automatically, any building that you rent out is not PP anymore. It becomes an investment property. And most investment property are measured at fair value model. You will learn that I'm not touching very well. They measure them at what? Fair value model. So that means you have to change your policy. You have to change your policy. So, because if you don't change it, relevant and reliable financial statement will not be guaranteed. So you have to, because of changes in what? Circumstances. Okay, so those are the situations where you change your accounting policy. Well, you know that investment property is not land and building. Lease it could be any form of asset. Okay, so that's changes in accounting what? Policy. Please, this two is what you need to know. Now, still on accounting policy, when there is a change. So, again, the essence of saying consistency of accounting policy is that so that we can be able to compare financial statement from one year to the other. That's the essence of consistency of accounting policy. So if you now change the accounting policy, then it becomes a challenge to compare. Then when you change, you expect that you are going to apply that change retrospectively. When you change, you apply the change what? So changes in accounting policies should be what? Should be applied changes in accounting policies should be applied retrospectively. Retrospectively. So then the question is, what is a retrospective application? Retrospectively. Of course, you can guess. Abi? So as far back as possible. Abi? However, when we say as far back as possible, the way I want you to put it is, you should adjust the earliest financial statement presented. You should adjust what? The earliest financial statement presented. That is what you should adjust. You want to say something? Say it. Okay, so it's quite straightforward, because you know that in accounting, in reporting, the earliest will be the previous year. So let's say we have 2024 and we have 2023. Okay, so what we expect you to adjust is 1st of January 2023, the beginning of the earliest financial statement. So you adjust the opening figures of whether the assets, liabilities, or equity of opening of 2023. It will affect the other ones. What do you say? So, no, you're not going to 2022 ending. So you know that the funny thing is that you have already prepared your account. So everything is happening this year, right? Everything is happening this year. It's not like you are going to go and change. Everything is happening this year. Just that, you have an opportunity this year to prepare comparatives. 2024, 2023. The implication of that is this: you need to now prepare an additional statement. You need to present us opening figures of 2023. So that means that when you change your accounting policy and you need to apply those changes retrospectively, that's the only instance where you have to present 3 statements of financial position. That's when you present what? 3 statements of financial position for the current year, year end, for the previous year, year end, and the beginning of the previous year. 3. So your accounting policy now, you start adjusting it from here. Everything is happening, you are doing it in 2024. It's not like you are going to go and correct. No, you are doing it from here, and you will see them presenting 3 statements. So from there, by the time you adjust the opening balance here, it will update to this one, it will update to this. So majorly, why we are doing that is just so that we can compare. Because when you change accounting policies, the figures you will get becomes different. The figures you will get using cost model will be very different from the figures you will get if you use fair value model. Okay? So that when somebody picks your current year account, they are comparing. That is it for retrospectively. Okay? So what you have learned for retrospective application is that you are going to adjust the beginning of the earliest period presented. The beginning of the earliest financial statement presented. Okay? And in that instance, you have to present an additional statement of financial position of the beginning of that previous period. Okay? Of the beginning of that previous period. Okay. Finally, on changes on accounting policy, there's one more thing I just want to tell you. Right? I'm not seeing it in your question, but I just want to mention it. Okay? So, when a change in policy is required by an IFRS, okay, when a change in policy is required by what? Usually, the IFRS will have what we call transitional provisions. The IFRS will have what we call what? Transitional provisions. So this one will have told us, okay, this change that we are bringing, this is how you should treat it going forward. It is only in this instance that you don't have to do retrospective. Because a new standard, yes, it's coming exactly, it's coming from a new standard, and it's telling us that this is how you treat it going forward. So it's easy for us to tell our users. This is why there is a change in treatment. Yes, so when a change in policy